Hello, everyone. I'm giving a talk today, just continuing on from yesterday, where we were talking about macroeconomic policy, and we touched on monetary policy and fiscal policy as the kind of two twin drivers of how government manages the economy. And we touched on some of the sort of financial instruments whereby the government can adjust depending on what it wants to do, whether it wants to become more expansionary or whether it wants to contract the economy somewhat to reach the desired equilibrium. Now, we sort of overrun a little bit yesterday, and so I want to cover some of the material which is in the slides, so we don't have to go over it again in the audio time. But I want to leave the question of deficits to the audio class on Friday, and so the latter bit of the week 7 slides we'll touch on, because I want to touch on that a little bit. Given the current crisis, it's obviously going to impact Ontario's financial basis for quite some time, and it's obviously had a big impact already on the spending priorities of the government and how the government is going to deal with the economy in the future. But we'll come on to that a bit more on Friday. So what I want to do here is just take the story on a little bit from what we discussed, and really look at this section on sort of Canada and macroeconomic policy and the recent experience of Canada. And I think we've alluded to this several times during the course that there's something of a paradigm shift after a long period where we had a largely Keynesian approach to the financial management of the country, where we tended to be high spending, concentration on fiscal policy as the kind of engine of economic growth, lots of state ownership, and perhaps not the free market kind of private enterprise economy which we're familiar with today. It seemed to me that the government played a much larger role in the economy, at least until the 1990s, as a not just as a regulator or as a facilitator, but actually as an owner of businesses through the formation of crown corporations, but also playing a role in redistributing wealth to some extent. Some of the transfer of resources, economic resources within the society, were going towards the lower classes, if you like, the social groups, which would be disadvantaged somewhat. Now that went in tandem with this growth of crown corporations, as I've said. So the presence of the government was fairly wide. Now that sort of changed from the 1980s onwards, and I think we touched on the good reasons for that change. That the fiscal kind of stability of the Canadian state was called into question, and whichever metric you looked at, whether it was inflation, unemployment, debt to GDP ratio, they all showed a marked kind of negative turn, if you like. There was a desire for some kind of change, excessive spending, too high interest rates, government ownership, great deficits. This was all sort of familiar landscape for many Western governments, and I think we've drawn the parallel with Britain quite a number of times. It's probably the closest, most relevant comparison in many ways, although the historical experience was very different, of course. In many ways, the extent and the nature of government involvement was quite similar. So perhaps it's quite fitting that Canada should follow in the wake of Britain and embrace this kind of neoliberal agenda. Now, we talked a little bit about privatisation and deregulation, which were obviously crucial to this process. Curbing state control, if you like, transferring assets over to the private sector, incentivising business, increasing the number of shareholders. There were lots of different facets of this policy shift, which we can see resulting in a quite different society, a society which was a bit more entrepreneurial, a bit more dynamic, a bit more business friendly. When we look at the macro basis of Canada, we also see a great shift in the priorities of the government and the central bank. It's no longer about fueling aggregate demand, which it had been in the 60s and 70s and even into the 80s to some extent. And I should reiterate that governments are still concerned with these matters and stimulating demand, as we're seeing at the moment. We're obviously trying to avoid a scenario whereby there's a prolonged period of low demand if we come out of COVID-19 anytime soon. And so the government's doing everything it can to try and facilitate economic activity and spending to try and avoid this kind of underconsumption, which has been at the root of so many economic problems in the past. But from the 1980s onwards, there was a renewed shift towards inflation targeting, keeping inflation down, trying to reduce inflation, trying to reduce interest rates as well, as a means of having a more sort of efficient economy, trying to incentivize people to start businesses with cheaper rates of borrowing money, obviously. All the elements of a kind of neoliberal agenda, and inflation obviously a crucial element in the governance of any state. But it's kind of played second fiddle for many years to unemployment, largely under the steam of Keynesian analysis, which very much placed unemployment right at the centre of the concerns of most governments. So Bank of Canada, late 80s, early 90s, we have the Edmonton Manifesto in 1988. John Crow, Governor of the Bank of Canada, sets out a programme of reform, aiming as far as zero inflation, hoping to peg inflation. Now this was a new approach which many central banks adopted to try and really curb inflation. High inflation was seen as very devastating to an economy, and of course you couldn't really separate this out from high expenditure of previous years. It tended to cause inflation rate pressures within an economy if prices are going up all the time, if the velocity of the money supply is increasing, labour unions making wage claims, prices going up on the back of that. So it was a kind of vicious circle which needed to be broken, and inflation targeting was seen as the means of doing that. And throughout that period, from the late 80s all the way up to the financial crash, I think, as we've seen, we've referred to it a couple of times in the course, we have a period of very low interest rates and quite large degree of economic stability across the world, not just in North America. This goes in tandem with changes in manufacturing and changes in technology as well. More efficient means of production, higher productivity, technology facilitating that as well. Some bad aspects of that, of course, were the dot-com boom, the dot-com bubble at the turn of the century, which had been fueled obviously by the growth of that technology, but also by very low interest rates. So there was lots of credit, lots of money sloshing around. And I remember this myself when I was at university in the 1990s. The banks were virtually falling over themselves to give you money and to have you sort of on the hook for debt, but it was at very, very low rates of interest. It was a period where there was lots of credit, interest rates were kept fairly low, and lots of good things came out of that. The economy was developed in ways which perhaps wouldn't have been the case if we'd still had very high interest rates and high inflation. That would have curbed the amount of economic activity. So this period is often called the Great Moderation, between the late 80s and the financial crash, going up to the financial crash in 2008. A series of fortunate circumstances, all sort of combining to produce a kind of vibrant a vibrancy in the economy, where the sort of deep-seated fundamental problems of the 70s and 80s seemed to vanish. And of course, they came crashing back in 2008 after the financial crash. But certainly, when we look at the metrics of this, I think we showed a graph earlier in the course regarding the deficits in Canada, and when the federal government's been in deficit and when it's been in surplus. And this period very much stands out as one whereby the deficits of the previous years, some of them very large indeed, were diminished by the 1990s, and we enter a period of small but still significant surpluses. So the federal government, to be in surplus is quite seems quite unusual to our eyes now, but it was for over a number of years. Financial crash changed all that, of course. The government then had to act in a more overt way in the economy, and here we are in 2020, and I guess we're going to see the same kind of thing occurring today. It's going to be similar elements of government intervention, perhaps even worse, depending on how long everything lasts. So I'll end the video here, and I'll just talk a little bit in a moment about the Bank of Canada and fiscal policy.